Good afternoon, everyone. It's Ben Buckner and Dan Bossy with the Ag Resource Company in Chicago. It is Tuesday, the 23rd of December. Everyone's getting into holiday mode. So we first want to wish everyone a happy holiday season. We really appreciated being with you this year. We thought we'd take a little extra time and get a little bigger picture in what kind of path will we all walk in 2026. And that's been kind of the bread and butter of ag resource for the last couple of decades. Things will happen. There will be weather concerns and issues, and there will be things happening in the background in the first half of 2026. But Dan, I thought I would let you kind of break down the framework of the markets that we're looking at. What changes things, what we've seen the last 12 months? And is there anything that changes things for the next 6, 8, or 12 months into the future?
Ben, thank you. But let's start out here with a Merry Christmas, Happy Holidays. Thank you for your business. Ag Resource is always appreciative of the opportunity that you give us to help you navigate very difficult markets in very difficult times. If you were to look back in 2025 and ask me, what was the most difficult aspect of the year? It was all the volatility, the news volatility. I mean, there were some days that I was writing wires and doing research that things changed one or two times relative to the news flow, thinking back to the tariffs of last spring in April in particular and all the things that happened. So again, appreciate your business, and Merry Christmas and Happy Holidays. Jumping in beyond that, I think the one thing I would look back at the past year and say, what the grain markets didn't do very well. There's only one grain that was really higher for the year, which was soybeans, based on a late year surge from demand from China, and of course, fund buying that accompanied that. If you notice, corn, wheat, cotton, the big loser being rice down 32%, soybeans being up 8%, but everything else kind of being mishmash in the middle. In that, you've got a year which the corn market is finishing out approximately where it was last year, or where we started the year last year. So again, not much there, and I think it's very good to put this in context before we really start out. As you then think forward in terms of where we're going, I always point out that bull markets that Ag Resource looks at going forward is based on demand. And we just don't have a demand driver. If I go back and look at that period between 2007 up to 2013, that was the arrival of biofuels in terms of how did that build demand for ethanol. We now use about 45% of the U.S. corn crop for ethanol each year. And then, of course, we had that phase one trade agreement with China, along with the supply chain breaking down during, of course, COVID, which gave us that other big run in 2020 up to 2024. Now we've slipped into something different. And you can look at all the years in between, Ben, and notice that farmers may make a $50 or lose a 50 or 100. It's not a great time to be in business unless you think forward to the opportunity that's there. And, we at Ag Resource are not cheerleaders for the market. We try to be realists and make decisions based on what our research tells us and what we really need to be doing. And lately that has been selling forward in the premiums that are offered in the deferred contracts for new crop and, of course, for this year's crop. I think it's worked out very well for all our producer clients. Our main job heading into the new year and the holidays is to make sure that you as a producer or you as a trader make it to another holiday or to another year. And so that is very important in our thinking at Ag Resource Company. As you look at the year ahead, we are still in this stocks building phase. So, notice going backwards in time, we are in this phase where now we're into the roughly fourth or fifth year of building corn, wheat, and soybean stocks in the United States. So unless we have weather abnormalities, this is still a year to be selling rallies, selling any kind of bounce that happens in the market in a deferred position to lock down margin for you as a trader or you as a farmer. That's where we find ourselves today. These are not difficult markets, although they seem that way. We have an excess of supply, and until we find a new demand driver, it's going to be hard to launch any sustainable rally. So there are bounces along the road, but these are the bounces that you want to be selling, just like we saw with China and, of course, the soybean rally, which occurred from October into the middle of November. Now, you're hearing a lot of talk from the U.S. farm community about costs, and they are exceedingly high. You can see in this graphic, we plotted corn and soybean costs of production going back into 2000. Now, the one thing I'll point out on this chart is as costs go up, notice that they may go sideways, but they never decline. Once that hand is in your pocket in terms of a farmer, it's very difficult to take it out, and things are unlikely to soften dramatically. Now, as you see, the big driver of costs here in the chart, and you're right, it's really been equipment, that red line. Farm equipment prices have skyrocketed and soared. That is really along with rising land rents and land costs have been a big contributor. Yes, seeds part of it, maybe a little chemical and fertilizer, but again, it's equipment and land and rental costs that are the big drivers in terms of all of this. Now, whether or not farmers plant more soybeans next year, we think they will. It's all due to their lower costs of production. You can see in this graphic very acutely that it costs much less to plant a soybean crop. We think also due to rotations, we'll find more soybean acres. We're looking at about 86.5 million acres of soybeans, 93.5 million acres of corn, largely due to that corn cost being the second largest on record. When you think about the past year as we go into 2026, it was a year of abundance. When we look at corn, soybean, and wheat production, we produced about 1.36 extra a billion bushels. When we think about this in 25, 26, it was a large, large amount of supply. So when you think about stocks, they are up substantially at a new record. So all of this additional supply, if you will, is really added to the downside complexity of the market and really has given us the softness in price that we're seeing in the wheat market. Then, of course, the soybean market. Thankfully, we've had some demand in U.S. corn based on Ukraine exporting about 8 million metric tons less than a year ago. That has pushed that demand to the United States and given us this good corn export profile. But Ukraine still has a corn to export, as do Argentina. So they will be returning late in the upcoming calendar year. And that will, of course, be a pressuring feature in terms of U.S. corn exports down the line. But not today. We need to get past the January crop report first. But again, notice how crop production this year was so large and what this really meant. A lot of this is due to, of course, Latin America. Latin America's production continues to rise with additional acres, with soybean yields that look to be very close or above trend this year, but also due to crush and exports. So Brazil will now have a soybean crop that's about 1.5 times the size of the United States. This is going to be important. We see it about 180 million metric tons. And as this goes forward, this is going to be an export enhancement for the Brazilians. They will be exporting soybeans all the way through 2026 and really getting into the U.S. export timeframe of September through December. So that used to be the traditional U.S. export period. Brazil is now encumbering on that. And I think it's going to be very important to understand going forward. Now, a lot of the good crop weather has been because we have no Nina, no La Nina, no El Nino, or if they are there, they're going to be very, very weak. We have a weak La Nina today. It may be showing a little bit of strength here in the month of January. But as we look at the ENSO forecast going forward, it's another year of not a strong El Nino or a strong El La Nina. So with that in mind, I'd expect normal weather. Normal weather seems to be the cadence that this market is looking at. And I don't have any reason to back away from that thought process, at least as starting here in the early January. The other thing I'd mention to everybody becomes very important is if you look at this square, look at how many soybeans China imported from May, June, July, August, and September into really October. This was China preparing for a trade war with the United States. We write at Ag Resource that they are awash in soybeans, and they are because of these big import totals during this time frame. Now, import totals will drag lower here in November, December, and January. The Chinese will take their 12 million tons of U.S. soybeans, but we're uncertain whether or not there's a deal for 25 million metric tons for 26, 27, and 28. The Chinese are not confirming it. The USDA or U.S. government has said back in November that there is a deal for that amount. But again, Ben, I'd like to hear the Chinese say that they've done a deal for 25 million metric tons for the next 3 years. I don't think that deal is there, but it's very important to the longer term direction of the soybean market, because otherwise we find ourselves, the United States, back in the same spot where China will be absent from the market really from February all the way into July. And then we'll be crossing fingers, toes, and hands to basically hope that they come back to the market as a buyer for our new crop. So in a general sense, Ben, we really end up with a year kind of like last year, a lot of choppiness. We need to be selling rallies in the deferred position. I don't make up these stories. We see this in our research. This is what happens. We are there to protect you as a farmer and a trader. And we do believe there'll be money making opportunities, but you got to be ahead of the curve. And that's our job at Ag Resource.
Yeah, I think that's right. And so we've done a lot of work going through scenarios, and it does seem that fundamentally we're going to start 2026 really right where we left 2025. Keep in mind, Brazil starts harvesting soybeans in bulk now in just 2 weeks. Argentina will start harvesting corn in March. So we're going to have, barring weather issues, replenishment of physical supplies. And I think that's most important. The one thing that we do think about, how do we change the structure of the markets moving forward? And it is all weather. So I think that's just kind of what we're down to. But we will start 2026 trying to identify things that do change. We just don't see anything meaningful today. So we want to be prepared. That's, I think, our mantra. And again, 2026 most probably looks a lot like 2020 25. So stay prepared to manage risk. We'll leave it there. We'll be back in 2026 with everything you need to know. And again, we wish everyone a very, very happy holiday season.